Have you ever wondered what happens to rental prices when big cities hit their limits? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. Today, we're diving into the latest data from Statistics Canada on the intriguing dynamics of the Canadian real estate market. According to Stephen Ponwasi's article from Better Dwelling, rents in Canada's cheaper cities are experiencing an explosive growth, while high-cost markets like Toronto and Vancouver are witnessing a decline in one-bedroom rents in the third quarter of 2025. This phenomenon is known as the catch-up effect, where demand shifts from expensive primary markets to more affordable secondary ones. This shift is not driven by local economic fundamentals, but rather by the movement of capital and displaced demand. It's a classic late-cycle dynamic where expensive markets reach a saturation point, leading to a spillover effect into more affordable areas. This has resulted in a strong inverse correlation between price and growth, with the most expensive markets cooling off the fastest, while the more affordable ones are seeing the strongest gains. For instance, Trois Rivieres, with the cheapest rent at $1,030 per month, experienced a 13.2% growth in one-bedroom rents year over year in the third quarter of 2025. Meanwhile, Vancouver and Toronto, with monthly rents of $2,390 and $2,160 respectively, are at the bottom of the growth chart in negative territory. This trend suggests that speculation and credit have taken over, rather than local factors driving the growth. It's important to note that while these smaller markets are catching up with more expensive ones, they may not have the economic strength to support such growth. This could lead to significant affordability challenges and economic instability in these regions. However, this also presents opportunities for investors who can navigate these shifts wisely. The Montreal apartment building transaction market has seen a remarkable surge in activity, with over $572 million worth of properties changing hands in just under 2 months. According to a report by RENX, 4 major transactions have been completed, involving over 1,800 apartments. This sudden uptick in transactions is indicative of the strong demand for multifamily assets, which are increasingly viewed as a defensive investment in uncertain economic times. Mark Sinnott, Principal and Executive Vice President at Avison Young, highlights that multifamily has always been considered a defensive asset, attracting investors looking for stable, cash-flowing properties. One of the standout transactions was the $128 million acquisition of 3 16-story towers on McDonald Avenue in Côte-Saint-Luc by Federal Real Estate. This portfolio contains 440 units and has historically maintained a 99% occupancy rate. The buildings, constructed as high-end luxury assets, have been owned by the same family since 1974 and offer amenities like a squash court and a 24-hour doorman. This sale underscores the appeal of well-maintained, high-occupancy multifamily properties to investors seeking long-term growth and stable income. Another significant transaction was the $249 million sale of the Central Park Laval by the Sarukian Group to Boardwalk Real Estate Investment Trust, marking the largest multifamily sale in Quebec for 2025. This modern, purpose-built rental development, located adjacent to the Carrefour Laval Mall, includes amenities such as a rooftop infinity pool and a sky lounge. The sale also highlights the trend of institutional investors pouring capital into new purpose-built rental developments, which offer both stability and potential for expansion, with plans for additional towers in the future. Furthermore, Avison Young is currently marketing the West End portfolio, a collection of 828 apartments across 5 properties in the Montreal area. This portfolio presents a substantial opportunity for investors due to its below-market rents and potential for value creation. With an overall occupancy of 80% and average rents of $951, there is significant room for growth through tenant turnover and upgrades. This aligns with the current investor sentiment, which favors stable, cash flow generating assets in the multifamily sector. While the multifamily market in Montreal is thriving, there are some challenges on the horizon. Recent federal government policies aimed at reducing temporary foreign workers could lead to slightly higher vacancy rates in gateway cities like Toronto and Montreal. Despite this, the stability and defensive nature of multifamily assets continue to attract investors. The recent transactions demonstrate a strong confidence in the sector, with investors eager to capitalize on the long-term growth and income potential that these properties offer. In a significant development in the Toronto real estate landscape, Hazelview Investments has announced the closure of one of the largest ever Canada Mortgage and Housing Corporation insured loans. This loan is part of the MLI Select program and will support the completion of a major multi-tower apartment project at Bloor and Dufferin in Toronto. The development includes 856 units of market and affordable housing, spread across two towers connected by a 7-story podium and an additional mid-rise tower. This ambitious project is not just about housing. It's part of a broader master plan community that includes a newly built affordable building with 56 units, a public park, a community center, a daycare, and a public road, all of which will be conveyed to the city, along with a Toronto Transit Commission tunnel. The community benefits package associated with this development is valued at $79.8 million, highlighting the project's commitment to creating a vibrant, inclusive community. The financing for this development is being provided by First National Financial and insured by the Canada Mortgage and Housing Corporation. While the exact amount of the loan wasn't disclosed, Hazelview's managing partner and head of real estate development, Michael Williams, emphasized the project's contribution to addressing the nationwide challenges of affordability, accessibility, and urban density. He noted that purpose-built rental housing is a critical part of the solution. The project is well underway, with occupancy targeted for the latter half of 2026. The development has already achieved significant milestones, including exceeding benchmarks for accessibility and energy efficiency as part of the application process. This commitment to sustainability and community impact is a testament to Hazelview's dedication to creating long-term value for both their investors and the community. Looking forward, marketing and leasing for the apartments will commence closer to the project's completion. The development promises a wide range of amenities, including 14,000 square feet of interior space on the 8th floor, complemented by 12,000 square feet of exterior amenities. These features are designed to offer a hotel and restaurant feel, complete with a gym, party rooms, a kids' room, a theater room, guest suites, barbecue areas, and an outdoor garden. This project is a shining example of how diverse stakeholders can collaborate to overcome the challenges of delivering housing in today's market. By bringing together municipalities, developers, engineers, and construction professionals, Hazelview is setting a standard for creative solutions in real estate development. This initiative not only addresses immediate housing needs, but also lays the groundwork for future community development. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.